The United States is heading towards a credit crisis. It is very possible that in the next 6 months or so, we will see some pretty nasty bankruptcies throughout the banking side of our economy. Why do I say this? Right here next to me, you will see the yield curve. I'm sure all of you guys are familiar with the yield curve, so we're not going to spend too much time talking about what it is, rather what it means when it looks like this, because what you're looking at right now is not a typical yield curve. In a normal functioning market, we want the yield curve to look like this, where a short duration bond will give you less money than a long duration bond. Locking up your money for 3 months should give you less of a yield than locking up your money for 30 years. That makes sense. That's how it normally functions in our banking sector. However, if you look back to 2006, you will see that the yield curve was inverted very similarly to what's going on right now. Our yield curve is even more inverted than it was back in 2006, 2007, which obviously was the years leading up to the financial crisis, the 2008 housing crash. So a short bond, a 3-month bond, was giving you more value, more returns than a 30-year or a 20-year or a 10-year bond was. If you pay close attention to the yield curve as we progress from 2005 into 2008, you will see that we slowly inverted, meaning short duration bonds yielded more than long duration bonds, and then right before the financial crisis hit, we snapped back down, meaning the short duration bonds quickly dropped their yields. Everything came collapsing down on that side of the yield curve, and then we see equities collapse. We see a massive crash. The same thing happened in the dot-com bubble, where we had an inverted yield. And then as soon as the yield curve got back to normal, we saw a devastating crash in the economy, or at least in the stock market. We have an inverted yield curve, and currently it is rapidly uninverting. If you draw your attention over here, the 2-year to 10-year spread. This is the one that most people pay attention to when looking at the yield curve. This is the most important pairing. This is a 1-year chart of the inversion. If you look back in July, we were inverted by 1%, which is a massive inversion. If you look currently speaking, we are inverted by 0.3% and climbing very quickly. You look back to March of this year, you'll see the other time where we uninverted rapidly. Do any of you guys remember what was happening in the banking sector during March of 2023? Silicon Valley Bank went bankrupt. One of the largest banks in the entire tech industry went belly up because they had mismanaged funds and invested too much money into the bond market, and bonds collapsed when the Federal Reserve was raising interest rates. The more the Fed raises interest rates, the tighter economic conditions get. That's not rocket science. Everyone's super familiar with that. So this rapid uninversion of the yield curve is telling me that there is likely something going on behind the scenes. If you draw your attention over to the actual chart of these bonds, this right here, the SHI, is the 1 to 3 year Treasury bond ETF. You will see that the price fell off a cliff as the Fed started raising interest rates, because interest rates are inversely correlated to the price of a bond. The lower the price, the higher the yield. The higher the price of the bond, the lower the yield. So as people sell out of bonds, the yield goes up. As the Federal Reserve sells out of their bonds, the yield on those bonds go up. That's kind of how they impact interest rates. That's how they set the desired interest rate. Now, I'm going to propose a question to you. If you believed we were headed into a recession, would you or would you not buy the safest assets that are guaranteeing you some returns? Obviously, you're going to buy the safest assets that you can if you have money that you're trying to protect. And people with a lot of money obviously want to protect it. Right now, these bonds, specifically a 3-month bond, is yielding 5.508% on your money. That is an insane return for something that's virtually risk-free. The problem is nobody's buying them. Nobody is buying them. In fact, people are continuing to sell them. If you can go look at this one as well, TLT. This is the 20-year Treasury bonds. These are falling off a cliff even more. People do not want these bonds. This is driving the yield even higher. The current Federal Reserve interest rate is set to be between 5.25 to 5.5%. And I know I'm throwing a lot of stuff at you guys, so feel free to rewatch this video. Ask any question that you have. Put it in the comment section. I will answer every single one of them. If you have insight you want to share, please feel free. Put it in the comment section. There's a lot of things, there's a lot of moving parts, and a lot of reasons behind what's happening is happening. I'm just here to try and present as much as I can to you. If you look, the Federal Reserve has set interest rates to 5.25% up to 5.5%. Because it's an open market, they can't dictate exactly what interest rates are going to be, so they give that range. The 3-month bond is the closest representation to what the federal interest rate is supposed to be set at. And currently speaking, it's higher than the maximum range. Very slightly, like this is nominal. This is not super catastrophic to see, but what is interesting to see is that over the last 3 months, it has raised from 5.3 up to 5.5. So even though they haven't moved interest rates in the last 5 months, or the last 3 months, excuse me, interest rates are still climbing. Because bonds are still selling off, because investors are afraid of purchasing credit in the United States. Investors with a lot of money are nervous that something is happening under the surface. It also could mean that banks are starting to offload some of their bonds in order to fund customer deposits. If you were to go take a moment and look at what happened to Silicon Valley Bank, I don't think I have it pulled up anymore, but they invested too much money into bonds, and when customers came looking for that money, they had to sell off those bonds to give them the money back. They had to sell those bonds at a loss because all bonds right now are at a loss. If you've bought a bond in the last 2 years, 3 years, you are probably upside down on that bond. If you hold it to maturity, you're all good. But the problem with the bank is they don't have the option to hold it to maturity if investors try and take out their money. So as investors are running to the bank because of some crisis, they are having to sell their bonds even more, which is driving yields up. Remember, they're inversely correlated. So as they sell off those bonds to give customers their deposits back, the yield rises. This is very insane. This is actually like concerning. It leads us into a credit crunch in the United States. And really, there's two outcomes as far as I see it. The first outcome is that the Federal Reserve has to cut interest rates. Because the interest rates are too high, a lot of banks, such as banks like Silicon Valley Bank, which went belly up and had to sell off all of their bonds and caused this uninversion of the yield curve back in March, that fear is rippling through the markets once more, meaning the Federal Reserve would have to cut interest rates to prevent some kind of catastrophe in the credit markets, in the banking sector of our economy. The other potential outcome is that they don't do anything and we start seeing banks fail once more. If banks begin to fail, the only people who are going to get hurt are people with a lot of money. FDIC insurance will cover up to $250,000 in a bank account. So anything above that in a bank account, you lose. The average person, the average American, doesn't even have $1,000 in their bank account, let alone $250,000. So they're not going to get hurt by a bank failing. The only people who get hurt is big money, large investors, institutional investors, people with money, right? The 1%, the top 1%. What do we know? What is very reliable for our government to do anytime the 1% gets hurt? They're going to print money. They're going to bail them out. It's a guaranteed thing at this point. They will bail out the 1%. They'll bail out the banks if they start going under. It's exactly what they did to Silicon Valley Bank and all the investors there. They didn't bail out Silicon Valley Bank, but they absolutely bailed out the investors. If we look at the M2 money supply really quickly, you'll see right here, back in April, March is when Silicon Valley Bank went belly up, and in April, the money printer started turning back on, and we started seeing an increase in the M2 money supply. So it is very much guaranteed that if banks begin to fail, they turn the money printers back on, which in the long term just hurts the little man, or realistically, it hurts anyone who's not holding assets. When the money printer turns back on, assets go to the moon. Inflation starts kicking in again. And the first thing to inflate is asset prices. So either way, I see the Fed being forced into having a U-turn. We're at the point now where there is a crisis brewing. The Fed is backed into a corner again. I know they see it, and they're waiting. They're patiently waiting to see the outcome of the CPI report that's happening on October 12th, as well as the JPM and Wells Fargo's earnings reports happening on October 13th, and the JOLTS data, the job openings. This just came out a couple days ago, and they came in strong. So if the economic data comes in strong for the next few reports here, CPI and bank earnings, if they all come in strong, interest rates are going to remain elevated, and the weaker banks are going to begin having crises. If CPI comes in low and the earnings reports for these major banks come in not as favorable as investors would prefer, then I think that we have a good chance at the Federal Reserve cutting interest rates. Your time's your most valuable asset. If you made it this far, you might as well subscribe. There was a lot of information thrown at you in this video, so hopefully I did a good job in conveying my thoughts to video format for you guys. I'll see you at 9 a.m. Eastern Standard Time when we go live to trade the crypto markets.